to our inaugural Tearsheet Talks. I'm Tearsheet editor Zach Miller, having a very interesting conversation today with Yaakov Erlichman, who's the head of capital and small business risk at Stripe. Let me tell you a little bit about the session that we're going to have today. This session is going to provide a practical framework for integrating proprietary and third-party data sources in small and medium business lending to drive effective underwriting. We're going to discuss recommendations for sequencing data introduction, balancing model predictive power with applicant friction reduction, optimizing the mix of internal and external data, and managing model degradation. Attendees will learn strategic and tactical best practices for maximizing the fusion of internal and external data to enhance credit decisioning and risk management for SMB lending. Session's going to cover conceptual and implementation considerations for reconciled data sources tailored to the unique needs of the SMB market. So this one is going to be different from some of the other sessions that we've launched, which maybe were more theoretical. Yaakov's going to take us deeper into some of these practical considerations. Yaakov, welcome to the show. He's a seasoned risk management professional focused on credit risk across both lending and acquiring. Currently, he's responsible for leading the credit strategy at Stripe, focusing on the vast majority of users who process payments on Stripe's platform. He joined the company 4 years ago to build the risk infrastructure for Stripe Capital, which provides working capital for small businesses globally. And prior to Stripe, Yaakov was part of the risk teams at Kabbage and American Express. Welcome to the show, Yaakov.
Thanks, Zach. Good to be here.
And I know I've been working on Yaakov to join us for a while, and I think we found the right environment, the right topic. Thank you for sticking with us. I'm excited to talk to you today. Let's jump right in. When launching a lending product, help us think about what data sources are critical for initial launch.
Yeah, no, it's a great question. Thanks, Zach. Good to be here. So I think that one needs to think about really what data they have access to, right? Like that's the most important thing. Money is very, very fungible, right? In the SMB lending space, there's a lot of lenders out there, those lenders are offering a product that are all very similar. So really to differentiate yourself in that market, you really need to use data, right? Like data is ultimately what's going to differentiate you because you're going to be able to offer better pricing, approve more customers, and just create a better user experience, right? Users are going to apply. They're already going to be pre-approved because you know so much of information about these users, and it's a really good experience for them. So what I would think is that, if you're a standalone lender, it's actually quite difficult, right? Because you're not going to be able to differentiate yourself against anybody else. It's really just going to be, the same data sources that everyone has access to, whether it's going to be, the commercial bureaus or the consumer bureaus. So you really have to think about how you want to differentiate yourself, and it's actually quite difficult. I would say if you can try to be an embedded lender, and I'm a little bit biased. Coming from the Stripe perspective is that if you are an embedded lender, you should really be leaning in as in the early days to your own data, because that's really going to differentiate you from anyone else out there. Something about your customers that no one else knows, right? So let's say, going to be a little bit inward looking here. You're a payment processor, and you can see that a user is really, really consistent in their transaction volume. Lean into that. If they're a coffee shop on the block and you can see every single day that they have the same number of transactions, that's a pretty good signal as to the riskiness of that business. And you might want to exclude any external signals, right? I remember a case that we had a boat rental place in the middle of Vermont. And they were so happy that we were able to offer them funding because we didn't look at their consumer bureau. We didn't see their 500 FICO score. We just saw their consistent transaction volume. And I think that really is a differentiating factor. So lean into that internal data, especially when you launch.
Yeah, and I totally get that the challenge between being an external lender versus an embedded lender. So the advice here is, if you can, become an internal lender, an embedded lender, and use the data that comes through the platform. So, but obviously, most of the lenders we speak to use both internal and external sources of data. How do you think about managing the mix of those types of things?
Yeah, so I think it's actually really important because if you happen to be an embedded lender, I'm probably telling you something that's very obvious. But at the same time, you have to be cautious about how you leverage internal data, right? If you are a lender that let's say, again, we'll use the payment processor example, and you're saying, oh, look at this transaction volume. It's really, really consistent. You might be only picking up a small signal on that business, right? You might only be seeing, 5, 10% of their volume. Maybe they use another payment processor that's very volatile. The volume on that is very volatile. Or maybe they're really heavily into cash and wires, right? And so that would give you a different signal. So there is a cautious balance that you need to strike. As you evolve over time, to ensure that you're really understanding that business. The key to all of data is just to fully understand the health of a business, right? Whether it's internal or external, the business is a business, right? Like the business just wants you to understand that. And unlike consumer, where things are quite clean, right? Like everyone has access to Consumer Bureau. Most of your trades get reported to the Consumer Bureau. Commercial is still the wild, wild west. There's nobody who's picked up all the signals and put them into one repository. So it gives you an opportunity to differentiate yourself in that space if you are able to pick up the right signals and weight those signals in an effective way. But it's critical that you understand that, because if you're really leaning in on internal data, you could be erroneous in your decision because you're not fully picking up all the signals.
So in that case that you brought up before, Yaakov, of the boat rental company, knowing that the individual, the proprietor, had a 550 FICO score, what impact did that have on your decision, using that one just as an example?
So secret sauce here is we didn't look at Consumer Bureau. We didn't actually look as part of that decisioning logic. We built out our models on our internal data. And again, there was some caution that we had to have that you're
not necessarily seeing the whole picture, right?
And in that case, maybe we could have been in a bad spot, right? Because if we had all of these low FICO customers that maybe had a propensity to default, maybe we would have got ourselves into trouble. But going kind of to the modeling piece, is we were really confident in the models that we built against our internal data. We really did a good job of back testing them and having a really, really strong data science team that was rigorous in their approach in how we treated that internal data. And again, when we launched actually only with internal in this case. But over time, we evolved. We evolved to say that, maybe we could expand our market share if we got additional information, right? Those 5-10% of users that are on our that we're processing only 5 to 10% on our platform, right? We didn't have full information about them. So we kind of eventually evolved to similar what everyone does as a standalone lender, to take in banking data, financial data, and other data sources to supplement our internal data.
Got it. And I appreciate that reflection about your guys' process and maturation. But obviously going out to ask for external data, if you are an embedded lender, there's some trade-off, I guess, in user experience, right? Can you talk about what that looks like from your perspective?
That's a huge component, right? And that's really a differentiating factor. Again, going back to money is fungible, but the user experience is like critical as part of the journey. Using internal data, right, is a great way to differentiate yourself, because you can come up with much stronger offers to your customers or to your prospects, not to your customers.
And proactive offers, I guess, right? Based on what you're seeing. Yeah.
Yeah, exactly. So we can go to a user and say, we're 95%, even higher than pre-approved. We're like, you're approved basically for this offer because we are so confident in our models. Just click here to take the money. There's no application. There's no information that we're asking to gather from you. And that is a great experience that we can provide. But again, that experience can only be provided to some users. You're not going to be able to provide experience to all users, but at least for those users, it's really a differentiating factor. And so, talking to other lenders out there, can you get to a point where you're sourcing data in such a confident way that you can provide that frictionless experience to a user to really say to them, hey, we know so much about you before you even show up at our door. Here's an offer or here's money. You just click here to accept it. That is really an awesome experience for a customer.
That is really powerful. How do you strike the right balance between heuristics and models?
Yeah, That's a great question, Zach. Initially, you're going to have to really lean in heuristics. You're not going to have the data that's going to allow you to build the really rigorous gradient boost models or logistic regression models, or even the new modeling techniques that are out there. You're really going to just have to use some industry experience and just talk to folks that are really experts in this domain area, and really understand, okay, what are the parameters that we can put into place, and what are the basic rules that we can put ourselves into place to keep ourselves out of trouble, right? So I would say, if you're going to be pulling FICO, what FICO threshold are we going to be comfortable with? And the other thing I would say is and balance that against how much you want to learn. One of my previous employers, one of the lenders that was out there, they wanted to know how far into the credit box they could go and still make money, right? So like, how low of a FICO threshold can you go and still be profitable? And in order to do that, you have to test though, right? So you can put some parameters in place and you can say, okay, this is how we're going to operate, but you also have a hypothesis, is like, how much am I willing to invest? And think about it as an investment. It's really money you're going to lose, but how much money are you really going to invest to be able to get the data, to buy the data that you need to be able to build your models? And that's what the heuristics will allow you to do, is really build out your data sets that will allow you to build your models. Most companies are not going to be in a position to get the right data on day 0, or even negative day 10 or negative day 100, to build out the models that will allow them to launch on day 0. So you really are going to have to use heuristics, and think about those heuristics as an entryway into buying data that will allow you to build out the models, which is ultimately your objective. Your objective should be to transition from heuristics into models, because models are much more powerful than individual rules.
So as you describe sort of this evolutionary process, sounds like lenders go through as they go from starting up to maturing their models. What kind of resources do you think about that lenders would need to ensure optimal deployment?
Right. So I think that a little bit biased here is you're going to need a strong credit risk team that's going to be able to that process, right? Somebody who really understands the domain area, is an expert in lending, whatever that lending that might be. It could be consumer, commercial. A lot of those skills are transferable across different verticals. But somebody who's able to kind of create that structure. And I think you're really going to need a strong data science team. I think that the successes that we've been able to achieve have really been driven on the backs of our data science team. And I think it's also important to call out that a data scientist is not, just having the label of data scientist is not going to enable your success. I've seen a lot of challenges where companies hire data scientists that are experts in advertising space, or in marketing, or in other areas.
They have a PhD in statistics. Yeah.
Don't transfer over well to the financial services world. And there's one key differentiating factor that I see is the time to learn is very important. When you launch, you're a Google engineer or you're a Facebook engineer, and you launch a new algorithm on the site, and you can get your results instantaneously. Is this going to lift our, on Amazon? Are you going to have the customer going to buy more products, buy more dresses, buy more shirts, based upon how you adjust the screen, or adjust the algorithm, whatever it is. In lending, your time to learn is months, if not years, right?
Years, right? Vintages.
Yeah, you have a 1-year working capital term loan. It could take you 12, 15, 18 months until you actually see performance, right? And a lot of data scientists don't appreciate that time to learn. And a lot of product managers don't think about it as well, which is another important call out. So I think you need somebody who has that perspective, that like, I'm going to launch the boat, or I'm going to launch the I don't know, we think about it as like a roller coaster. You launch the car down the ramp. You have no brakes, no controls. You're just going to let that go. You don't know where it's going to end up. And so having that frame of mind is critical as you think about financial service products.
I like that metaphor. I mean, given this sort of, we talked before about the give and take with it calling on external data sources for a user experience. I'd love to go deeper into thinking about how product offering is affected by data.
Yeah, no, I think that you really can lean into the product side, at differentiating yourself. You can really take the data that you're able to understand or accumulate about your users and transform that into the product. So, for example, you can have insights into like let's think about like the volume, the cash flows of a user. So you can really tailor your product around the risk strategy. So for example, you could have a seasonal business, right? Our favorite is our landscapers, that are very busy, right? From let's say April to October, right? And you could offer them a product, right? You could go one way or the other. You could say I can offer them a product during their busy season, right? Or you can offer them a product during their low season, right? To help sustain them
Bridge
into.
them. Mm-hmm.
And so that is a differentiating factor, right? Like a lot of lenders that can do that, that are strategic about how can we shape a product to really the needs of our customer, right? Do we want to help that user during their off season, or do we want to help them during their busy season? There's reasons to do both, right? But even having those insights to inform the product strategy are incredibly powerful. And you can message that as well. We're like, hey, we know that you're going into a low season, or hey, we know that you need to buy inventory and buy, and ramp up your business before you go into your busy season. We want to offer you some money to be able to do that. That is hugely differentiating, if you're able to get to that level.
It does sound hugely differentiating, and it sounds also something that's more applicable to an embedded lender than a standalone lender. I would assume.
Yeah, I think that is true, but at the same time, anyone is able to do that if you're thinking about how
Thinking
do
about it, right?
to inform my product strategy, right? I think that a lot of product managers just think about risk as like a checkbox, right? Can I approve the user, yes or no? And that isn't really fully, that's very narrow-minded. I think that if you expand it, and risk can really be a product enabler, right? And say, how can we scale our products based upon using sound risk strategy? And that's how we operate here, is that risk is really a driver of product growth. Because we are thinking through not just like, can we keep ourselves out of trouble, but like, no, how do we optimize our returns? How do we optimize our conversion using risk as a differentiating factor? And data is what ultimately drives that. That's ultimately what this comes down to.
Got it. How would you recommend some of our attendees here to go about selecting vendors?
Yeah. So I think that I'm not going to specifically call out like individual vendors, but I think there are only a handful of very unique, large vendors that are out there. And I think that, well, actually, I will call out a couple. You have like the DNB, the Lexuses, the Equifaxes of the world that are really good at what they do. They're able to provide, very broad understanding of a lot of users that are out there. And I think it's worthwhile to have conversations with them to see what they offer. But I will caveat though is that in the commercial space, it is really challenging to use a commercial bureau in an effective way because they don't necessarily have access to like the granular information. A lot of the information they have is like a little bit, I would call distilled a little bit, or actually not distilled. It's a little bit rough around the edges. Like they're taking information from, I don't know, various ad hoc
Trade
sources
lines and stuff. It's not, yeah.
that don't necessarily do not really paint a complete picture of a user. That being said, there are some very effective scores that are out there. DNB has a couple of scores that are quite good. I would say the CSS score that they offer is quite good. It's also quite expensive, but the value is there. So I would think about that, that you need to be more thoughtful about, how you want to measure that. But if you're starting from scratch, I think those are very effective. You should be having conversations with those bureaus. I think over time, though, I think what I've seen, I don't want to say what we've done, but what I've seen is that the alloys of the world where you're able to take multiple data sources and they provide a lot of rigorous balancing and underwriting of the data, it could also be a really good way to lean into multiple data sources rather than you having to set up relationships with a lot of lenders or a lot of vendors, excuse me. What I would say though is that I haven't seen a lot of very effective like newcomers into this space, which has been unfortunate. I don't see a lot of in the commercial space. I don't see a lot of new entrants into the space that are offering differentiating products on the commercial side. There were a couple of companies that were trying to do it, but it is a very, very difficult thing to do. I will say, actually, before I forget, I will say SBFE, which I'll plug SBFE if you're not familiar with that, is a small business financial exchange. It's kind of a secret sauce, but it's a very effective consortium of commercial lenders that are out there. They span, there's probably 500 lenders, and I don't know if a lot of folks know about this. But they're a give to get consortium. So it means you have to sign up for the consortium and participate in it. They are a great source of information, probably one of the best sources of information to really understand the risk of a user, because commercial trade lines get reported to them. And they've done a really good job of managing that information and effectively disseminating it to their membership. So that is actually a secret sauce that I will share with the group here.
Thanks for that. And SBFE, are there, because they're multiple givers, you're able to triangulate a particular borrower from different perspectives, or?
Whole conversation about SBFE, but it is an anonymized database. So you have, so this is like the criticality of the database is that you have no anonymous where you're getting that information from. But it was actually started by the banks. I think Chase and Amex and Citi were the ones that pulled together it, and they wanted to compete on the product side. They didn't want to compete on the credit side. No one wants to see someone else lose because that someone else goes bust or there's a lot of fraud or whatever it is. You want to win on the product side. You have a better product, better pricing, better whatever that you're able to offer to your customers. And so the idea behind this is that I should know if somebody is stacking or somebody is just taking on an excessive amount of debt, right? So I would say, okay, that's cool. I'm going to pull back from this user. I'm not going to approve them. I'm going to take some risk actioning. But there's no way to use the SBFE to identify who the other lenders are. It's only you'll see that this user has X number of debt outstanding and they'll have a number of trade lines, but you have no idea where they come from.
Got it. We're near the end of our conversation. I'd love to, and it's something you alluded to before, Yaakov, was this idea that when you start out, it's sort of this car in a roller coaster, and it takes time to figure out how the models work. Well, how do you think about the frequency in terms of evaluating performance, both at like the portfolio level and the model level?
Yeah, so I think you have to constantly be evaluating your model performance, right? Models degrade pretty fast, I would say. So I would say you should be looking at your models every 3 to 6 months and constantly determining whether they're still performing as expected or whether there's been any degradation. And you should be constantly looking at what additional features that you can update in your models. There's constantly new developments, whether they're internal signals or external signals, that will really inform how your models are performing. One of the things that we added, in the last year or two is just the recession and recession signals, right? Basically looking at how the overall economy is performing, right? When you initially launch, probably not relevant. If you have a small portfolio, that's probably not going to be meaningful. But as you start to scale, you could really start to see meaningful differentiation from external signals like that. And so I would say you should be evaluating what features you could be adding every quarter, and then you should just be monitoring your models probably every 3 to 6 months and deploying new versions of those models at least twice a year.